Get ready for massive market moves because we are diving straight into the action. We start with Amazon and the big question. Is Amazon starting an Nvidia-style run? We break down how Amazon Web Services is supercharging its AI growth with massive capital spending and the exciting potential of its in-house chips like Graviton and Trainium that are delivering serious revenue run rates. We look at how this positions Amazon to challenge the giants in the chip market and why investors are watching this stock closely right now. For Nvidia investors. And finally, we tackle the deep technical shift redefining Nvidia's future moat. We explore the context memory setup, revealing how Nvidia is moving beyond just selling GPUs to controlling the entire AI factory architecture. With technologies like Dynamo and SpectrumX, this is about turning storage and data movement into a crucial part of the inference bill. And we'll figure out if this changes everything for NVDA. Stay with us, because this is the future of AI infrastructure. Amazon is facing scrutiny over whether it is poised to begin an Nvidia-style stock surge, driven by its significant positioning within the artificial intelligence revolution. Nvidia has experienced explosive growth, surging over 1,500% in the last 5 years due to its dominance in providing the most powerful compute for AI development, leading to record earnings. However, Amazon is also gaining momentum, with its shares climbing over 30% since late March. Amazon's integration with AI spans multiple areas. The e-commerce segment benefits from AI-driven efficiency in its fulfillment network and personalized customer experiences through virtual assistants. More significantly, Amazon Web Services, AWS, the world's leading cloud provider, is the core driver of its AI success. Demand for AI and non-AI services on AWS has been surging, prompting Amazon to announce $200 billion in capital spending for 2026, with anticipated revenue generation between 2027 and 2028. Oz caters to AI customers through a diverse portfolio, including specialized chips, systems, and the Amazon Bedrock platform, which enables the creation of custom AI applications and agents. The company's internal chip business, featuring the Graviton Central Processing Unit and Trainium AI chip, is also a major focus. Nvidia estimates these in-house chips are generating a $20 billion annual revenue run rate, a figure that could increase substantially if these chips were offered to external customers. While Amazon has suggested the possibility of launching a standalone chip business, current high demand necessitates prioritizing Oz customers before expanding externally. This strong demand is fueling revenue growth and investor excitement. Analysts suggest 3 key reasons why Amazon might see an Nvidia-like run. First, Amazon could secure a major market advantage in the chip sector through its own products, potentially through a standalone business, which investors are keenly anticipating. Second, as investors rotate into new AI stocks, Amazon offers a compelling alternative to the current leaders. Third, Amazon is an established tech giant with deep chip expertise, similar to Nvidia's history in the video game market, providing a fresh boost to its stock. Furthermore, trading at 30 times forward earnings estimates, Amazon is considered reasonably priced given its growth trajectory and future potential. These factors collectively suggest a potential shift in investor sentiment toward Amazon. The Delaware Chancery Court is set to hear significant litigation this week, with Boeing taking the lead in defending against shareholder claims related to safety issues. Boeing Co. will be arguing before the court to dismiss shareholder lawsuits stemming from safety problems, specifically referencing the 2024 incident involving the blowout of a door panel on a 737 MAX 9 jet operated by Alaska Airlines. In other developments from Delaware courts, the schedule includes a settlement hearing on Monday, May 18, 2026, concerning May v. Gore's Guggenheim Sponsor LLC, case number 2023-863. This matter involves Vice Chancellor Lori W. Will, who is required to grant final approval for a $25 million cash settlement. This settlement is intended to resolve litigation surrounding Polestar Automotive holding UK PLC's blank check merger with a shell entity, a maneuver aimed at taking the electric vehicle startup public. Nvidia investors should understand the historical performance patterns following quarterly earnings, as the immediate reaction is often only a fraction of the full story. Analysis of historical data shows that while buying the stock just before results yields modest short-term gains, the long-term outlook is significantly stronger. Over the period since 2016, Nvidia's post-earnings returns have consistently been positive across all holding periods examined. However, the magnitude of these gains varies significantly by timeframe. The median returns are modest in the short term, 0.3% after 1 day, 3.3% after 1 week, and 0.4% after 1 month. In contrast, longer holding periods show substantial upside, with median gains rising to 11.1% over 1 quarter and an impressive 87.6% over 1 year. This data provides crucial context for traders anticipating the next earnings report. Options pricing currently suggests a 6% post-earnings move, which is above Nvidia's typical daily volatility, but aligns closely with its recent performance potential. Nvidia's earnings volatility is a defining feature of its stock behavior. For short-term traders, the initial reaction can be unpredictable, even when the stock delivers a significant swing. This unpredictability highlights why longer holding periods are more advantageous. Historical win rates, the percentage of time performance is positive, improve markedly as the time frame extends. For example, the win rate is 55% after 1 day, jumps to 60% after 1 week, and reaches 53% after 1 month, climbing to 78% over a quarter and 84% over a year. This indicates that patience often outweighs immediate prediction in navigating Nvidia's post-earnings volatility. Furthermore, tracking the rolling 10-quarter average of 1-year post-earnings returns reveals cyclical patterns. While the peak performance during the AI boom saw 1-year payoffs exceed 150%, the current rolling average stands at 70%, yet the broader historical pattern remains consistent. The stock's strongest historical performance after earnings has typically favored investors who allowed the trade sufficient time to materialize. Nvidia's next strategic advantage in the AI market is shifting from raw GPU compute to controlling the context memory layer, a crucial bottleneck for advanced, long-running AI agents. This analysis suggests that as AI agents become the default enterprise workload, the ability to manage the data path surrounding inference, including cached tokens, retrieval results, and session history, will define Nvidia's future moat. The traditional view positions Nvidia as an accelerator supplier. However, the emerging thesis argues that the company is evolving into the provider of the entire AI factory architecture. This is driven by the complexity of agentic AI, which requires continuous state management across multiple steps, making memory movement a significant revenue challenge. Nvidia is actively addressing this operational problem with a suite of technologies designed to make memory movement efficient. Key components include Bluefield for SDX, Dynamo, CMX context memory storage, SpectrumX networking, and AI enterprise solutions. These are positioned not as isolated products, but as an integrated inference architecture. Nvidia frames traditional storage as too slow for multi-step reasoning, claiming that its context memory solutions offer significant improvements in token throughput, energy efficiency, and page ingestion speed. Early adopters among this context memory storage include major players like CoreWeave, Mistral AI, and Oracle Cloud Infrastructure, underscoring the seriousness of this development. Crucially, Nvidia is moving beyond selling just chips to selling the infrastructure that keeps those chips utilized. Dynamo, an open-source distributed inference serving framework, is central to this strategy. It aims to disaggregate inference, optimize request routing, and extend memory through data caching to lower-cost storage tiers, effectively publishing the scheduling logic for AI workloads. This focus on factory economics, cost per token, throughput per watt, and production deployment is a deliberate pivot away from simple benchmark performance. The argument is that a GPU underutilized due to slow surrounding systems represents wasted capital expenditure. By controlling the memory path, Nvidia aims to ensure that every high-end inference deployment carries a wider Nvidia bill of materials. This context memory thesis differs from the established high-bandwidth memory, HBM narrative, which focused on the accelerator supply chain. The context memory focus is on the post-deployment data path. If successful, Nvidia's economic unit shifts from one GPU sold to one token factory kept busy. While the immediate focus remains on the upcoming May 18th earnings report regarding Blackwell demand and supply, the deeper, long-term investment question is whether Nvidia can own the working memory of AI agents. If they can standardize the entire operational pattern, compute, memory, networking, storage, and software, it creates a formidable barrier to entry that is harder to replicate than a simple chip benchmark. The primary risk identified is that hyperscalers and major AI labs may abstract this context memory layer with their own proprietary software and storage designs, limiting Nvidia's incremental attach revenue. Furthermore, investors will need better metrics than raw flops to value this shift, focusing instead on the cost of completing complex tasks rather than just peak speed.